Most historical accounts of the Great Depression begin and end with a single week in October 1929. The standard narrative points directly to Wall Street, positioning the stock market crash as the sole engine of the decade-long economic collapse that followed. This graph shows the raw equity data. The Dow Jones Industrial Average climbed from a baseline of 63.9 in 1921 to a peak of 381.17 in September 1929, before the violent liquidation in late October. But an equity market crash alone cannot mathematically account for the systemic failure that defined the 1930s. A contraction in paper wealth does not automatically erase a third of the global economy. Between 1929 and 1933, United States real GNP contracted by 30.7%. By 1933, unemployment peaked at 24.9%, leaving roughly 12.8 million workers without wages. Concurrently, the M2 money supply, the actual volume of currency and deposits circulating through the economy, shrank by 31%. These three metrics describe a complete mechanical failure of the macroeconomic system, distinctly separate from a localized financial panic. The October crash acted as a catalyst. It struck an economic machine already compromised by severe structural vulnerabilities. The financial damage was transmitted and multiplied by three specific hidden gears: extreme margin leverage, an undiversified unit banking system, and the rigid international constraints of the classical gold standard. To understand how the global economy shrank by a third, we have to look past the chronology of the crash and forensically deconstruct the physical transmission mechanisms that turned a recession into a depression. The late 1920s equity boom was heavily financed by debt. By September 1929, approximately $8.5 billion in brokers' loans were propping up market positions. This chart models the mechanics of that 1920s margin leverage. Speculators typically required only 10 to 20% in investor equity, borrowing the remaining balance at call loan rates of 8 to 12%. The initial price decline triggered automated margin calls. Investors were forced to liquidate assets to cover their loans, selling into a market that was already falling. This mechanically drove prices down further, triggering the next wave of forced selling. Economist Irving Fisher formally identified this self-reinforcing dynamic as the debt deflation theory of depressions. This loop was compounded by a severe drop in the consumer price index, which fell by roughly 25% between 1929 and 1933. Because loan contracts require repayment in fixed nominal amounts, a fall in prices and wages meant the mathematical burden of those debts actually increased in real terms. Borrowers who could have serviced their loans under stable prices found themselves insolvent. This triggered a wave of defaults and foreclosures that spread the financial distress directly into the real economy. Classical economic theory assumed price flexibility would act as an automatic stabilizer, enticing buyers back into the market. Under conditions of heavy leverage, falling prices acted as an accelerant that actively destroyed solvency. This geographic node map contrasts the structural architecture of the banking sector. The United States operated under a unit banking system consisting of approximately 25,000 isolated single-branch banks. State-level regulations restricted these banks from establishing regional branches. This left individual institutions entirely dependent on the health of highly localized agricultural or industrial economies. Canada, by contrast, utilized a nationally branched system. When a localized shock occurred, the Canadian banks pooled the risk across their national network. Canada experienced zero bank failures during the entire Depression. The fragility of the American system was compounded by the complete absence of federal deposit insurance prior to 1934. Because depositors bore the full risk of a bank's failure, uncertainty triggered a highly rational game theory. If you suspected your bank might be insolvent, the only logical move was immediate withdrawal. This logic was self-fulfilling. If enough depositors withdrew simultaneously, they would drain the cash reserves of even a fundamentally sound, solvent bank, forcing it into illiquidity and collapse. Between 1930 and 1933, over 9,000 American commercial banks staled or suspended operations, vaporizing roughly $1.3 billion in unprotected deposits. The banking panics were not a psychological phenomenon. They were the mathematical inevitability of an uninsured, geographically undiversified system buckling under stress. Economists Milton, Friedman, and Anna Schwartz argued that the depth of the depression was primarily caused by the Federal Reserve allowing the M2 money supply to collapse. This diagram shows the international mechanism that constrained the Federal Reserve, the classical gold standard. Major industrial nations were linked by rigid currency pegs tied directly to gold reserves. The standard operated on strict mechanical rules. If a nation ran a trade deficit and experienced gold outflows, it was mathematically required to contract its domestic credit and money supply to restore balance. The system possessed a structural asymmetry. Surplus nations like the United States and France, which together held over 60% of the world's monetary gold, faced no reciprocal obligation to expand their credit when receiving gold. Economic historian Barry Eichengreen demonstrated that this asymmetry turned the international monetary system into an engine for global deflation. Any nation attempting monetary expansion to fight domestic unemployment risked a gold run. Defending their currency pegs forced nations into increasingly severe contractionary policies. In 1931, the collapse of the Austrian bank Creditanstalt triggered a European banking contagion that eventually forced Britain off its gold peg. The gold standard acted as a set of golden fetters, providing a rigid transmission belt that guaranteed a localized U.S. downturn would mechanically synchronize into a global depression. The Hoover administration is frequently characterized as entirely passive, but this overlooks major interventions like the Revenue Act of 1932. Intended to balance a widening federal deficit, this legislation enacted a massive peacetime tax increase. By draining capital from the private sector, precisely when it was most needed, the policy acted as a pro-cyclical shock that worsened the contraction. This chart tracks world trade volume. In June 1930, Hoover signed the Smoot-Hawley Tariff Act, triggering immediate retaliatory tariffs from major trading partners and contributing to a 66% collapse in global trade value. Following Franklin Roosevelt's inauguration in 1933, the New Deal introduced massive public works programs to absorb the unemployed labor force. This chart compares New Deal expenditures against the total output gap. While the government disbursed over $41 billion, the fiscal stimulus was mathematically insufficient to fill the cavern created by the collapse in private domestic investment. Federal deficit spending during the New Deal never exceeded 5% of GNP. The aggregate demand generated by the state simply could not offset the vast scale of the economic destruction. This vulnerability was exposed in 1937, when a premature attempt to balance the federal budget, combined with the onset of new payroll taxes, triggered a sharp secondary recession. While the New Deal succeeded in building essential modern safety nets, its fiscal interventions were too small relative to the total destruction of private aggregate demand. This diagram synthesizes the triad of failure. The specific severity of the Great Depression was caused by these three transmission mechanisms locking together simultaneously. A leveraged credit boom met an uninsured banking system, while rigid gold rules forced a 31% monetary contraction. A look at the empirical data reveals a clear pattern. Nations only began to grow again the exact moment they broke the rules of the international transmission mechanism. Britain abandoned its gold peg in September 1931, severing the link to the deflationary spiral and experiencing a rapid industrial recovery shortly after. The United States followed with a major monetary regime change. Between Executive Order 6102 and the 1934 Gold Reserve Act, the dollar was devalued by 69% against gold, allowing the domestic money supply to finally expand. The nations comprising the gold bloc, including France and Switzerland, adhered to the standard until 1936 and suffered the longest and deepest depressions among major industrial economies. The Great Depression was not a natural disaster. It was an architectural failure of institutional design. The economy did not self-correct. Recovery only arrived when policymakers systematically dismantled the mechanisms that transmitted the panic.